Better. Okay, so we made this video a couple weeks back on how equity works at startups. But there's this question that kept on coming and that honestly we needed a whole video to answer, which was how to distribute profits. And what about profits in a startup? Does anybody care about it? And it is a very fair question, like Business School 101.
This is business.
Will teach you that for a company to thrive, you need profits. That's that you generate more money than you spend. But I mean, Business 101 is right, but that doesn't exactly apply to the dynamics of startups. So let me give you an example. When Facebook acquired Instagram, this is back in 2013, they paid $1 billion to buy the platform.
Instagram, a company with only 13 employees, bought today by Facebook for $1 billion.
Why did you do it, and what are you going to do with it?
When you look at a company bought for $1 billion that has no revenue, you have to step back and say, whoa, wait a second.
At the time, Instagram had not generated a single dollar of revenue. This was all expenses, and yet Instagram's founders, investors, ideally employees as well with stock options, walked out with very large paychecks out of that exit.
$1 billion, by any reasonable metric, it would have to be worth somewhere between probably 50 and 200 billion. So an amazing acquisition.
So why do these crazy numbers happen for a platform that generated no revenue? Well, after it got acquired, Instagram has generated billions of dollars in revenue for Facebook. And well, since Facebook stopped being cool, you could argue that Instagram is all that Meta has got to lure young audiences into their data capturing empire. Instagram did make a profit eventually, except that the original founders and investors, they never really collected any of the profits from Instagram. They made a lot of money, but not from these profits. And they never wanted to, they never intended to collect profits, but why? So in this video, I want to explain that. I want to explain how this profit model works. I want to run through some scenarios of profit-based businesses and startups and clarify why for venture capitals, the truth is that profits are just boring. Okay, so I'm going to start with a very traditional, but very common type of business, marketing agency. You can apply this to any services type of business. So this company will probably have two very important departments, which are growth. That means the people who do the sales and the marketing and the business development and essentially that get the new customers. And then the costs. That means the people who are in charge of doing the actual labor, the work. That's the designers and the marketers. Now, in a financial model, the expenses that scale with your revenue should classify as cost of goods sold. And as the company gets more and more clients, it obviously makes more and more revenue, but also that cost increases proportionally. The more clients, the more brains that you will need to deliver work for those clients. And there are other costs as well, such as admin and HR, and they also have to scale more or less proportionally to this staff, to your cost. So as your business grows, the amount of people grows too. And this applies to to many businesses, say an e-commerce platform. Your costs are the products that you sell. Let's say that still you manage to scale this company to $10 million in annual revenue, which is still a pretty big company by many measures. This might be an organization with 50 people, and they're all well paid and happy and they love working here. Now, while the gross margin on the services might be, say, 40%, but the net margin, after accounting for all the overhead costs and everything, the net margin usually ends up being about 5, maybe 7%. So this company made $10 million, and after paying for all their staff and all their costs, they end up with, say, $750,000 in EBITDA. EBITDA is earnings before interest, taxes, depreciation, and appreciation. So now the company needs to pay taxes on this EBITDA, on this profit. In the US, that's state and federal, and it varies state by state, but you can round this up to like 25%. So the company is gonna end up with $562,000 and $500 in profit after paying taxes. Now, the company can choose to pay that to shareholders, and that is usually a decision that depends on the board. So the board of directors has to agree. And in this, let's use this example. Let's assume that they're choosing to keep the $162K in their accounts as cushion, as operating capital, in case there's a recession or a pandemic. And they're gonna pay out $400,000 to shareholders. Let's imagine that this company got started with 3 co-founders on equal share distribution. So each one of them is gonna get about $133,000 for the year. Clean profits, right? No, not really. No. You've forgotten about taxes. Wait, taxes again? Didn't we just do the tax math? Well, yes, again.
So you want me to buy this place so I can pay taxes?
That's the double tax on dividends, which applies on many countries around the world. So assuming that these guys are single And assuming that they make, say, $150,000 in salary from the company, plus the new $133K that they paid in dividends, well, that effectively moves them from a marginal tax rate of 24% to the full 35%. It just applies as any other income for the individual. And it's even worse if you're not a US taxpayer. In those cases, you are taxed at a flat 30% on dividends if you're collecting dividends from a US company as a non-US citizen or taxpayer. But anyway, let's assume that these guys live here in Brooklyn. Their additional take-home income from this $133K in profits is now down to $74,000 because of all the extra taxes that they'll have to pay. But that's the founders. We haven't even talked about the investors yet. Let's imagine that this company raised money on some pretty standard, pretty normal startup terms to get off the ground. So maybe an investor came in, they invested $500,000 to get the company started, and in exchange for that, they received 15%. Again, this is a pretty standard startup valuation equity distribution. We have a whole video about it. That's the one I mentioned before, our video in cap tables. Now, I'm going to link it in the description. Anyway, the investor will make on 50% of $400,000, $60,000. That's their dividend distribution because of the 50% ownership that they have in the business. And this is before taxes. Now, assuming that the company continues to operate in the same way after taxes on $60K a year, it's gonna take them years, maybe decades, to even recoup just 1x of that original $500,000 investment. And that is honestly just too slow. They won't have liquidity, meaning they don't have access to the money, they can't use it for anything. For years, they can't really get the money out. It's also very risky because the company might fail, as many startups do. Also, they're at the mercy of what the board decides. If they own 50% of the company, they probably only have one vote in a board of directors of 3 people, or maybe 5 people, which is not enough to guarantee that they have a deciding say in these dividends. And they might have preferred stock or some other sort of instruments. But the point is that the company might just choose to keep all these dividends, or it might need to keep all these dividends for growth. So they can't get paid out very quickly, and it's not an exciting scenario for investors. And this is why traditional businesses that have such slim margins, they just can't raise money the way startups do. And this is a very common confusion here, because collecting profits is not the business of venture capital. There are investors that will fund these traditional businesses, but the checks are usually smaller, the equity stake needed is much larger. Say, for example, a restaurant. So a restaurant may have a financial or an executive founder. They're the ones that bring the capital. And then on the other side, they have the chef and the operator, that's the person who runs the business. And they're both together, they got together to build this business. Maybe they split 50-50. And the risk is still there, as any company, but the ROI may come much sooner because it's half of the profits. So why do tech startups get away with $1 million rounds of funding and fraction 15% equity stakes? Because taking profits out of a business is not the only outcome for that business. It's actually just one, and arguably the most boring one. Because aside from dying, which is always a possibility, a business can either be acquired or it can IPO. And both of those are very exciting because your payday comes really quickly. Venture capitalists actually expect to get a liquidity event, an acquisition or an IPO, in 7 to 9 years from their investment. So they can cash out, they can take the profit, pay their limited partners and whatever, but essentially use the money for their next investment. I still get the occasional founder that they're saying, like, I want to sell my company, I want to own this, and want to inherit it to my children. And that's cute, that's great, it's totally fine, but that makes your company immediately incompatible with venture capital, because it's a different game, it's a different business. It's not the game of venture capital and fast scaling startups. If you want to own 100% of the business, it's not for you. You need to be ready for an exit. Exits are cool because investors don't have to wait to collect the profits, or founders. They collect the price per share that the buyer is paying, and that means an entirely different ballgame in terms of amount of money, and even the fact that you can go and do something else. And for many of these acquisitions, the money that the buyer is paying is not connected to profits. So I'm going to give you a few examples. I want to give you a few examples of common acquisition scenarios for a tech startup and why they're so much different, so much more exciting than profits. But before I do that, I want to take a moment to thank our sponsor for today's video, which is ChartMogul. As you know, we don't make money from these videos. This is not our business. Slidebean, we're a fundraising OS for founders. That's a software as a service. And the platform that we use to track our SaaS revenue, our conversions, our subscriptions, our cancellations has always been ChartMogul. And this is for real. Like, I've seen SaaS companies bigger than us with millions of dollars in revenue, tracking it on spreadsheets. They're just not understanding these metrics at all. And on our side, we've used ChartMogul even long before we started our YouTube channel. To me, it helped me understand how these metrics look, how they get calculated. They even give you the formulas for them. And I genuinely can vouch for their product. They are the best SaaS tracking platform, automatically reporting MRR, ARR, revenue, customer churn rates. You can create cohort tables to analyze how your customer behaves over time, or maybe you can break them down by their region, or you can filter them out by the marketing campaign that brought them to you, and then figure out which campaign is working better, not only in conversion, but in lifetime value for the customer. A great platform, truly. They're free for any company under $10,000 in subscriptions, so you can start using them today if you sign up at chartmogul.com/Slidebean, link in the description. If you have over $10,000 in subscriptions, you can get $600 off on your annual subscription, again, using the link in the description. So ChartMogul team, thanks a lot for sponsoring all those videos this year. Let's get back to acquisitions. And I'm going to start with Acqui-hires. Now, the easiest example to understand is this acqui-hire. This is a startup term that comes from joining the words acquisition and hire. So an acqui-hire happens when a company buys out a startup, not so much because of their product, definitely not because of their revenue, but mostly because of their talent and their team. And the first example that comes to mind here is a company I know, founded by good friends of mine, called FlyLabs. They made this really cool video editing platform for your phone. And they saw some success on the App Store. They raised about $1.5 million in 2 rounds. It was clear they were going to need a lot more capital to reach market dominance. This money was not going to be enough. And I'm honestly blurring on what information I know, because they told me that I should not be telling you about, but I'll do my best to keep confidential stuff. The point is, they were not a profitable business. They were growing, they had thousands of users, many monthly active users, they had a revenue model, but they were not profitable, not gonna be profitable anytime soon, about to need a lot more capital to continue growing. Various companies, larger businesses, reached out to them because they wanted to buy them out, mostly because of their technology. The technology of video editing was kind of useful for the potential buyers for this business, but most importantly because the team that had built this very powerful app would be really useful for this organization that was trying to build an app that did something very similar. And the buyer ended up being Google. They ended up buying them out for an undisclosed amount to join specifically the Google Photos team, which at the time was still not the product that it is today. Now, when you have undisclosed acquisition amounts, that's usually because the amount of money that was paid is not a number that you can brag with. The offer that a company like Google might make to a company like FlyLabs, of course, needs to be enough for investors to accept it. So it needs to pay investors back at least what they've invested and a little more. And of course, it needs to be exciting enough for the founders and the rest of the team to be motivated to go work at Google, because that's what Google wants. They want you to go work there for a few years. So the deal is usually a combination of cash, that's mostly going to the investors, vesting stock, or time-based bonuses for the team, so that again, they're motivated to stay with the buyer for a few years. So a benchmark that you will hear sometimes, and it's a correct benchmark, is paying about $1 million per engineer, which may sound crazy. It's not that each engineer gets $1 million, no. It's that the company is valued on how many engineers it brings to the buyer, because engineers are very expensive, very hard to find, very scarce talent, and they're very hard to recruit.
Just look at them.
There they are, stallions.
So if you can suddenly go out and buy a team, bring a team to your company that already has rapport, that has proven expertise on a given challenge, that you can bring the whole team together to implement that technology together to your stack, maybe even recycle some code. Well, this effectively removes a lot of the costs, a lot of the risks of building that team from scratch by just hiring strangers and paying recruiters. So investors don't make a whole lot of money on acqui-hires. They usually get paid from 1x at least to maybe 1.5x, maybe 2x their original investment. Acqui-hires are cool, but they are truly mostly a soft landing for a company that is struggling to find another path. Another very common type of acquisition is the acquisition that goes related to customers and audience. And these are more strategic. This is like when HubSpot acquired The Hustle or when Business Insider acquired Morning Beer. Now, these acquisitions are happening mostly to buy out the audience that these companies have. So HubSpot revealed that when this purchase happened, The Hustle had about 1.5 million readers per month. And they revealed that this is what they cared about the most. They cared about this access to a new audience to allow them to continue growing on this content marketing game that of course is very profitable for HubSpot. Now, we don't know the acquisition price on this specific transaction, but internet seems to agree that it was somewhere between 25 and $30 million. Just Google it. Anyway, from this information, we can infer some things. We can run some math. For example, we can do math and estimate that HubSpot ended up paying about $20 per active reader on the Hustle. The Hustle had only raised about $1.3 million in capital. So assuming that the investors, this is just one round. So assuming that that round was reasonable average 15%, well, they got about a 2x payout, assuming that their stock was common. And it was even better for the Morning Brew guys. They got acquired for $75 million by Business Insider. So at the time of purchase, they had 2.5 million readers, 500,000 subscribers, and 6 million downloads on their podcast. Alex Lieberman, who is one of the founders, he has talked about this acquisition and the transaction, how that was negotiated in a couple of podcasts. I'm gonna link both of those in the description. By the way, Alex followed me on Twitter and follows our YouTube channel, which made me feel very much like a celebrity lately. Maybe he'll watch today's video. But anyway, the point is, both of these are media companies, and they were acquired not so much because of their team. I mean, a little bit because of their team, but mostly because of their engaged audience, and definitely or very likely not connected to their revenue. Audiences are valuable. They're very, very valuable to the buyers, in this case, HubSpot and Business Insider. This is access to more people, to more readers, to more audience, and they can bring this audience and monetize it in the same effective way with all the experience that they already have as media companies. And again, they're buying out competitors, they're removing competition from the table, and they're bringing these new smart brains to their organization that were able to engage an audience that they didn't necessarily have access to. So back to that Instagram acquisition, you could compare the $1 billion exit price that Facebook paid or Meta paid to the $25 million users that Instagram had at the time of the acquisition. That's about $40 per user, but it's not about the users or the revenue, definitely not the revenue in this case. It's the strategic significance of Instagram for Meta. This is younger users, this is fresh ideas, and it's even avoiding a competitor buying Instagram out and then competing more strongly with Facebook. And that brings me to the last example that I'll share today, which is this company called Quip, which was acquired by Salesforce for about $750 million. Remember that Salesforce also bought Slack a couple of years back. Quip was this simple, this well-designed office suite, this word processor type of spreadsheets platform. We considered them kind of a competitor for a while. They were not nearly as powerful as their Microsoft Office counterpart, but it was a simple and intuitive platform that had well product market fit with small businesses. Well, they had revenue and they had users when they were acquired. I'm sure the $750 million price might have been a multiplier of their annual run rate, but it related more to Salesforce's strategic goal, their end goal of building this operating system for sales. At the time of purchase, the company had raised $45 million in 2 rounds of funding, a Series A and a Series B. This is all according to Crunchbase. So let's assume that both of those rounds added up to some 30% of equity of the company that investors owned. That would mean that these investors went home with $225 million, which means 5 times what they invested in just 4 years. And that 5x in 4 years, that is the essence of venture capital ROI. It's not about percentages, it's about multipliers and quick in a few years. This gets even bigger if the company is not acquired, but even goes to an IPO. That's when it's listed in the stock market. And then in that case, the value is defined by the market, by people. And sometimes those markets value companies well above their revenue. We've seen that last year, just on their potential to change the world and how much they can grow. And whether those numbers are real or not, it matters very little to these original investors, because as a public company, when their shares are publicly traded, they can just cash out with time. I'm oversimplifying here, they can just sell them all at once. But the point is, if they sell them, or their net worth essentially goes up by 50 or 100 times compared to what they invested originally, especially if they got in early. And all of this startup investing is extremely risky, because most startups fail. Most startups will fail. Only a fraction of a percent of them will become unicorns and IPO. If they're not generating profits, they depend on other investors to also bet on them to continue building their vision. But that 100x unicorn as an investor will pay for your 90% of mistakes of companies that didn't make it. And that is very cold, very hard, tangible cash that you can collect from a success. A startup win like this is life-changing. It's generational, life-changing money for the founders, for their families, and 3 generations below. And of course for the investors, especially if they got in early. An exit also allows everybody to take what they've learned and apply all this knowledge and some of this money that they've made to a new venture. And this new venture will have a much better chance of succeeding, of achieving this same feat again. And in this world of exits and selling your company and IPO, profits, well, profits aren't necessarily the biggest thing you have to worry about. All right, I hope this video was useful, guys. I hope it answers your questions on profits. We are trying to hit, again, this is not our main business, but we're trying to hit 1 million subscribers by the end of the year. So if you want to hit that subscribe button, make sure that you stay tuned on our startup lessons and our company forensics content. See you next week.